Hello all, and welcome to Consumer Goods Night hosted by Inderes. My name is Thomas Westerholm, and I cover consumer goods companies at Inderes. I will be hosting a small keynote presentation about the industry more broadly, after which we will hear two presentations by two consumer goods companies later on, Marimekko and Orthex. As a reminder to all our listeners, after the presentations, we'll be having short Q&A sessions with the companies, and you're free to post any questions already during my presentation. But without further ado, let's dive into the topic of today. If we look at the Helsinki Stock Exchange and the listed consumer goods companies here, I usually like to separate them into two categories. Consumer staples companies, which produce and deliver products that are usually consumed, and hence their consumption is more stable. And then we have consumer discretionary companies, whose products have a longer lifespan and are hence used for a longer period of time. If we think about our consumer staples companies, we have a rather broad supply of them. For example, beverages produced by Olevi and Nokian Panimo, fish farming in the form of Fifax, meat production, Atria, HK Foods, plant-based food, Appetit Raisio, alternative protein sources, Solar Foods, ready-to-eat meals and snacks by Fodelia, and wine and spirits by Anora. Today we'll, however, be focusing more on the second category, consumer discretionary companies. Here we have companies like Marimekko that produces clothing and accessories, home storage solutions by Orthex, fireplaces like Tulikivi, fishing equipment manufacturers like Rapala, indoor and outdoor living products from the likes of Fiskars, sauna category, as in Harvia and somewhat Tulikivi, and also Nokian Tires that produces tires. But some things investors like about these consumer goods companies is that usually they have rather diversified customer portfolios and geographical diversification. Hence, they're not too reliant on a single customer or a single market area. Also, strong brands usually enable excess returns on capital, and hence the operations and growth is very profitable for these companies. Also, the industry comes with barriers to entry. It's hard to start to compete with some established players with strong brands and large production facilities. Also, from an investor's point of view, getting to know these companies may be a lot of fun, testing out their products and seeing how they work compared to competitors, for example. But if we think about the value chain of a typical consumer product company, these companies produce their products and then to a varying degree utilize wholesalers, retailers, and some go straight and sell directly to consumers. If we think about our companies presenting here today, Orthex, for example, relies heavily on their retail partners, whereas Marimekko uses a more hybrid approach, using retailers but also direct to consumer channels. But also thinking about these companies' supply chains, I feel like the last few years investors have paid special attention to even further upstream to where the products, the raw materials, and some other inputs come from, since these political tensions have made investors rather aware of, geographical linkages. But what should one look for in a consumer goods company? A strong brand that resonates with customers is usually a good starting point. However, some well-known brands do not lead to consumer willingness to pay. As investors, it's our duty to actually try to figure out, does this company have pricing power despite or although they have this strong brand? Sometimes consumers aren't willing to pay for a brand that is very known, and hence the company's financial performance might be hampered due to it. Another thing is economies of scale and scope. How efficiently does this company produce or source its products? There's massive differences between the most efficient production plants and the less efficient ones. So investors have to dive deep into how efficiently the operations are run in a company. But also balance sheet strength is vital. If a company has a strong balance sheet, it enables the management to just focus on growth, but also gives extra leeway for capital allocation in the form of dividends, but also M&A opportunities. And last but not least, sales and marketing capabilities. These are essential even if the product the company manufactures is superior, because how would the consumers else get to know of this well-functioning product? Here we have some macro drivers that investors investing in consumer goods companies should keep an eye on. Consumer purchasing power, since this is what fuels consumer spending. Consumer confidence, this is something that typically is a solid indicator, especially for larger discretionary purchases. A car, for example, when the consumer is afraid or has low confidence, this is a purchase they usually end up postponing. But also interest rates. These affect mostly big-ticket items financed by debt, but especially in rate-sensitive countries like Finland, where a lot of household mortgages are tied to short Euribor rates, this is something to really keep an eye on. Usually, the higher the unit cost of a product is, the more cyclical the demand for it tends to be. However, in this relationship, there is a kink. And that's due to, once your customer base really is focused on these higher income households or consumers, and you produce luxury items to them, that usually ends up being an exception to the rule, and they tend to be less affected by economic cycles in their demand patterns. But if we think about the last few years for these consumer goods companies, here we can see the European Commission Consumer Confidence Indicator Index from a very long time period. But if we zoom in the last few years, we can see that there was actually an obvious peak in 2021, which really was a superior operating environment for a lot of these consumer goods companies. However, the consumer confidence dropped in Europe very rapidly, and 2022 was a difficult year for a lot of these companies. From there, fortunately, the consumer confidence has somewhat rebounded here in Europe. Coinciding with the peak of consumer confidence were also very low interest rates we enjoyed in 2020 and 2021, but from there, the short rates, interest rates here in Europe, the 3-month Euribor and 12-month Euribor, for example, shot up very rapidly in 2022 and 2023. From there, the Euribor rates have been coming down, and this is something that really supports the purchasing power of households with mortgages or other household debt. Going forward, I feel like if this trend in dropping Euribor rates keeps on coming down, we'll see this really supporting, especially the more discretionary consumer goods companies. But here we have some KPIs of the 7 listed consumer discretionary companies I presented earlier on today. Here you can see that 2021 was really a very strong year for these companies. These are the averages of their growth rates and the median of the growth rates. After an extremely strong 2021 year, the group's performance stepped down in 2022, and 2023 really was a bottom of growth for these consumer goods companies. From there, the growth rates have somewhat rebounded in 2024, and we expect this rate to pick up in 2025 and 2026. Also, looking at the returns on invested capital of these companies, you can see a similar trend. 2021 truly was a very strong year for these companies. Their returns on invested capital dropped from there, and even 2024 has been a tough year for these companies. We, however, expect that a strengthening macro environment is going to allow these companies to improve their performance from here going forward. If we look at the share price performance of some of these companies, here to the left you can see indexed share price development of these companies. If you would have made a basket of these 7 companies, this would have outperformed the OMX Age 25 or the Helsinki 25 index. However, the performance would have been very reliant on 2 high flyers, namely Harvia and Marimekko. To the right, you can see some of the EV/EBIT multiples of this group. As you can see, at the beginning of the period in 2018, these companies were very conservatively valued with realized EV/EBITs of only 10 to 11. From there, they expanded quite a bit to 2021 in a very strong operating environment. So these companies their profitability was on a high level, but also their valuation multiples were high back then. And that has compressed to a certain extent. For a lot of these companies, both the multiples and the profitability levels have come down from there, which explains a lot of the weak performance of some of the companies. From here, we see, however, that the valuation levels are on a reasonable level, especially considering that a lot of these companies still have profitability levels that are somewhat compressed. But that's all for my behalf. As a reminder, if you have any questions regarding these companies, you're free to state them as we go in the chat box. But thank you for my behalf, and I would like to welcome Elina Ankar of Marimekko to the stage up next. Thank you.